markets, bank nifty. You look at any sort of sectoral index as well, there's a sea of red pretty much everywhere. As we speak, the nifty is down almost 600 points. That's where we're at, even though we've seen a bit of a recovery in the last few minutes of trade. The Sensex has lost almost 1,900 points. You have the bank nifty leading the fall. It had stayed resilient up until Thursday, but since Friday, we've seen that downturn. And today, again, it's extending those losses. The bank nifty losing more than 2,000 points in trade today. Leading the pack is the PSU stocks. Those are down significantly, almost 5% now as we speak, led by some of these names like Union Bank, Bank of India, Bank of Maharashtra. They're all down 4 to 5% in trade because of the impact that is being felt, the second order impact of what's going on in West Asia. The auto pack, bank nifty, metal, media, all of them are down, in fact, by 3 to 4% as we speak. Nifty IT, relatively better, still down about 0.5%. So that's where we stand in terms of pullers and draggers. Coal India, these are some of the names that are doing better. But of course, whether that is paints, aviation, they're all seeing the pain. But Hormuz, the Nifty has also entered a technical correction zone. Tell us exactly what that is and the significance of that.
How quickly do times change? At the start of the year, we were celebrating the Nifty hitting a new record high, crossing previous levels. And today, in just 2 months, we are entering a technical correction on the index. The record high for the Nifty, 26,373. Today's low, 23,697. And that is a 10% fall from record high levels on the index. And that is a technical correction for the index or for a stock. Of course, a 20% fall will mean a bear market, but we are still some distance away from those levels. For now, the Nifty has entered a technical correction. Now, what has transpired further, if you take a look at the index so far, now since the 5th of Jan until today, when you see in the index itself, there are 13 stocks that have delivered positive returns, 37 stocks that have delivered negative returns. And if we take a look at the market cap erosion for all BSE listed companies since the time the Nifty hit a record high, that figure is well over 40 lakh crore rupees. And that is the kind of erosion that we have seen on the index so far in terms of BSE listed companies since the 5th of January. Now, which have been the worst performers on the index when it comes to stocks? Well, if you would have thought about it, IT could have been the worst, but that's not the case. There are a few of them, yes. Wipro, of course, the worst performer, down 26%. Asian Paints is down 23%. TCS is down 22%. There is Maruti in the list. There is Jio Financial in the list as well. 6 Nifty stocks are down 20% from the January 5 levels. Now, there are certain names that have bucked the trend as well. If you take a look, now of course oil sensitives being the one, ONGC leading the pack here is up 16% from the 5th of January. Defense as a pack has done well. SBI, of course, after this correction today, it could have been higher, but still up 7% from that period. The stock was until very recently at record high levels. Apollo Hospitals has also done well during this period. So as of now, the Nifty is looking to recover from those technical correction levels, but is still in the red, still down almost 10% from record high levels. The only question is, when does this stop and when do we see a recovery back to those levels?
Yes, in fact, when we see that recovery is what we're going to be waiting for. But, the markets are, of course, going to take their cue from what happens in West Asia. The war has now entered the second week and you're seeing pain across the board. Oil making big moves there and impacting a lot of sectors, individual movers that we'll get you details of. But that's where we're at. Quick check of what's happening in terms of the market breadth. You have more than 10 stocks that are declining. If we pull up that line for you, for every one stock that is advancing. So, very much in the green. We'll see how the day progresses from here. But as of now, things not looking very good. But we'll move on to the big story of the day. And that, without doubt, is oil prices that have been skyrocketing up 20-25%. What we're seeing in a matter of days is what we would have normally seen in a matter of weeks, months and years. Prices have now soared past $115. In fact, as we speak, at about $112 dollars a barrel mark. Now, let's go across to Sonal Bhutra, who's combined the impact that these high oil prices could have across various sectors and stocks. Sonal.
Thank you so much for that. Well, yes, the impact will be seen across sectors. Now, do remember, India receives around 2.5 to 2.7 million barrels per day of oil from the Strait of Hormuz and around 30% of LNG via the Strait as well. So these are inputs for a lot of segments, and that's how the impact will come by. Let's start with the oil and gas space itself, because ONGC and Oil India, of course, if crude oil prices rise, it will be positive for them because they are oil producers as well. However, do remember, they will benefit only if there is no windfall tax this time around, something that we saw 3 years back because of high crude oil prices. For oil marketing companies, remember, diesel and gasoline prices or refining margins, they turn negative if crude is around that $75 to $82 per barrel mark, if retail prices are not increased. And if those prices are not increased, they will have negative margins in the marketing segment. The biggest impact will be on HPCL because they have the largest exposure to marketing segment, followed by IOCL. But BPCL could be resilient because of a balanced mix, while Reliance Industries will tend to benefit in their refining segment because remember, Singapore GRMs have surged to $30 a barrel from around $3.50 per barrel that we saw last week. So for every $1 per barrel increase in refinery margins, their EBITDA could increase by $500 million, which is around 2% of their EBITDA for FY27. But it all depends on how refining margins pan going ahead, and if there are no windfall taxes on these margins. For airline companies, of course, it's a negative. Crude is a major raw material. For Interglobe Aviation, analysts suggest that earnings will contract by 13% for every $5 per barrel increase in Brent crude prices. Chemical sector, of course, that is impacted as well. A lot of them have crude-based derivatives, crude-based raw materials. Some of the companies, Coromandel International, GSFC, because of the gas prices hike, as it is also linked to crude oil prices. Deepak Nitrite, Atul Limited, Aarti Industries, that has benzene as a raw material, which is again crude-based. Paints company is again, crude is a big part of their raw material basket. So all these companies tend to be in focus on the back of this big surge that we're seeing in crude oil prices.
Sonal, thank you for summarizing that for us. Aviation, paints, tires, OMCs, all of them getting impacted because of the rise in oil prices, which are now at 110. There has been a slight cool off though from higher levels for Brent as we speak. So 21% higher now. At one point, both of them were up 27% each just a few minutes ago. And this is on the back of this Financial Times report, which is saying that the G7 nations are going to meet and discuss a joint release of emergency oil reserves. Of course, there is nothing concrete on this as of now, but the news itself has led to a bit of a cool off in crude oil prices, a subsequent recovery in Dow futures, and then a recovery on our own markets as well. To discuss the impact of all of this, we are being joined by Madhavi Arora, the Chief Economist of Emkay Global Financial Services. Madhavi, good morning. Thank you for joining in. For a net importer like India, seeing oil at $100 is never good news. But what do you see this as temporary? How does this oil price rise impact the balance of payment situation for a net importer like India?
Hi, morning. So clearly, as you said, that oil impacts our economy in a direct fashion as well as indirect fashion. The terms of trade impact, no doubt, is going to be massively negative, right? Nobody expected that oil would actually, the war would sustain for this long and oil would actually cross 110 plus level. As we stand today, there is no sight of the war sort of getting over, which also implies that at least for a month or two, we could actually see this as a new normal. At this point in time, we're looking at the base case for us and Brent still at 75. We assume that the moment the war adjusts or sort of seasonal, we will see prices of oil sort of coming up naturally to a $70 per barrel kind of level. Assuming that it remains at say 100. I think we're looking at a current account deficit of as high as 2% plus of GDP, but more importantly, it will percolate down to the capital account, because clearly the impact will be also felt on the FPI flows. It will also be felt on other aspect, which is basically investment-led impact of our borrowings, and to be very, very sure, it will be also impacting the rupee dramatically. We already seeing that play out in the rupee market. Despite RBI intervening heavily in the last 5 trading days, rupee is crossed 92. And I think if oil continues to be at this level, we are pretty much seeing a 95 plus level. But Generally, on a static basis, when you look at these numbers, every $10 per barrel increase in oil leads to a current account deficit increase of around 0.5% of GDP, again on a static basis, but unfortunately things are never static. It's a dynamic world where other variables also tend to move as the terms of trade worsen.
Madhavi, you're still working with the base case of $70 a barrel crude. We're already seeing it in triple digits now. Last week, your note was talking about $90 to a barrel. The situation is moving very quickly. How long a sustain, will you wait for at these kind of levels before you have to revise your, CAD? You're already talking about a 2% kind of a level. The CPI for the year, the growth print, how does that get impacted? Let's say if this continues for another 3 to 4 weeks.
See, as I said, the numbers are based on the fact that things will normalize in a matter of 2 or 3 weeks. Honestly, we did not expect it to even escalate beyond last weekend. But that said, I think as of now, we're still sticking to the number because we believe that this is a pure supply side shock. At this point in time, assuming that things normalize, the demand supply balances are not as bad for the Brent market. But again, we do not know, how long this could stretch. The reality is that, we are in a situation where we probably would have to look at a much higher average Brent prices for the year. Before the war, we were looking at 65, increase it marginally to 70, 75. But I agree with you, if it escalates beyond another 1 month or so, we are looking at least Brent averaging a 280 plus levels. But as of now, I think we are making cases in our assessment, which I think is the right way to do things because we do not know where the end game lies in this war at this point in time.
Madhavi, the point being that now, as supply shock as it may be, but does this or will this have an impact on the inflation picture? As of now, inflation continues to remain under the RBI target range. How much of an impact do you see because of the rise in prices? There has been this, not just the oil price issue, there is also a supply side problem with regards to the exports being stuck and so on and so forth. How will all of this impact the inflation picture and more importantly, the trade deficit as well?
So, see, for the inflation bit, specifically the retail inflation, it's a function of how much pain is actually passed on to pump prices. Unfortunately, pump prices are still frozen, which basically means that a large chunk of the oil-related pain is at this point absorbed by the OMCs. We're not expecting government to immediately bail them out, but again, we will have to see how fast and how long this war continues, and how long do we see the oil prices sustain at these levels. If that happens, of course, we will see the government of India also intervening in terms of, bailing out the OMCs, and the balance sheet impact would be seen on 2 or 3 factors. One of those being how much of the pain the government bears, how much of that is actually passed on to consumers. As of now, from the retail inflation point of view, the impact is still insulated to some extent. But again, on a static basis, if you assume that the pass on is full, every $10 increase in Brent tends to increase CPI inflation to close to around 35-40 bips as per the new series. But again, I don't think the pass-through effect would be full because there will be absorption of the price pain both by OMCs as well as the government. As of now, it's the OMC which are bearing the brunt of it. For trade, again, as I said, the current account play is very clear. It's 0.5 for each $10 per barrel increase in Brent from our base case. The base case could actually move from a 70 to a 90 to 100. We do not know at this point in time. So the play is such that the longer the what plays out, the more the impact you will actually see in the capital account. Nobody will talk about the current account bit, because we may still have some way or the other to sort of pull it through. But the capital account will become a big concern. So, at a 70, we're looking at
Madhavi,
a balance payment of around $15 to $20 billion negative. At a 90, 100, it would actually go to a 60 or 70 billion, which is a big deficit on a balance of payment. So the funding issue would be really,
let me just interrupt you.
Concerning for me.
Madhavi, let me interrupt you since we're running out of time. I just quickly wanted to understand, do you think RBI can afford to look through rupee at 92 plus kind of levels, oil at $110, $115 a barrel kind of a level, when it meets in 3 to 4 weeks? And has your base case changed now, from the pause scenario that everybody had factored in?
again, for the Reserve Bank, I think the problem is more to do with financial stability than to do with the inflation management. That becomes a very second-order problem for the Reserve Bank. I think we all are aware that the Reserve Bank is intervening in the forex market, both in the spot and the forward, and that will have implications for liquidity back home as well. So they are going to be, and they are only facing the dilemma of managing the currency as well as the domestic liquidity, because the pain of the currency intervention is directly felt in the money market. As of now, we're not expecting the Reserve Bank to take any action because large chunk of it is obviously externalities, and one doesn't know how long can it get dragged. We anyway understand that the RBI's conventional rate cutting cycle was over, but they were still ensuring that liquidity doesn't remain a constraint for the economy, and they were anyway ensuring that the balance sheet also increases to the extent that they are able to support growth. That will become a problem because growth will be an issue. Fiscal will not have the leeway to intervene beyond the point.
Running out of time, Madhavi. So thank you so much for sparing time and joining us today. Let's go across to the Rajya Sabha. External Affairs Minister S. Jaishankar is making a statement on the situation in West Asia.
Has been assessing the situation in West Asia continuously since the 12-day war in June 2020. We noted the indications of growing tension and cautioned the Indian community in Iran accordingly.